Assalamualaikum to our beloved lecturer Madam Shariniza binti Kamarul Arifin, and welcome to our video presentation. In this video, we will be presenting about the analysis of corporate financial performance for Post-Malaysia Berhad and Gdex Berhad. First of all, my name is Siti Nurhazira binti Anwar, and I will start the presentation with the introduction for our case study. The company that our group chose for this case study is Career Service Company, which is Post-Malaysia Berhad and Gdex Berhad. A career service is a service that allows someone to send a parcel or document from one location to another. Nowadays, career service becomes part of our daily life, especially during the outbreak of COVID-19 virus. The reason why we select Post-Malaysia Berhad and Gdex Berhad is because they are the two most well-known career company in Malaysia. Post-Malaysia Berhad currently delivers to over 9 million addresses nationwide with a network of more than 3,500 touchpoints and over 315 self-service terminals, while Gdex Berhad grounds steadily spanning over 150 stations in Malaysia. As we can see, both companies are still standing strong by giving their best service and still trying to improve their services to meet customer satisfaction.
Okay, hi. So I am Nur Ashafati Muhammad. Let me start with the first Post Malaysia background. Okay, so let's continue. Post Malaysia Berhad is a Malaysian postal delivery service with a history since 1800. So it is a flexible provider of the postal, and its company has operated in Malaysia, Singapore and Thailand. So it has an exclusive concession to provide the mail service in Malaysia via its network more than 926 branches and mini post office. So the headquarter of the company is at Ibu Pejabat Pos Besar Kuala Lumpur, Malaysia. So Post Malaysia provide postal and related services like standard mail, courier express and parcel CEP, retail such as bill payments, driving license renewal, international mail, logistics and e-commerce. Okay, so let me continue with the strength of the Post Malaysian Berhad. As we can see, it is a vast market and well-known services, and provide a more safe and less negative feedback from the customer, which is the Post Malaysian Berhad having a high rating from the customer compared to their competitors, and it's provide a variety of the services like carrier renewal, the license, postage and other services. So the weakness of this company, it take the delivery services take a very long time and prolonged waiting time at the counter, which is at the Post Malaysian office.
Gdex Berhad is a Malaysian investment holding company and is one of the country's fastest growing express delivery firms. The company was previously known as GD Express Carrier Berhad, but in December 2020, it changed its name to Gdex Berhad. Gdex Berhad was established in 1997 and has been listed in Bursa Malaysia Stock Exchange since 2005. The company's headquarters are in Petaling Jaya, Malaysia. Okay, next, the core business for Gdex Berhad. Gdex Berhad provides express delivery and logistics services in Malaysia and internationally, include Vietnam, Singapore and Indonesia. The business is divided into three segments, which is express delivery, logistics and property investment. Okay, so for express delivery segment, Gdex Berhad offers services such as next day, same day, diplomatic, bar, delivery order return, cash on delivery, late pickup, normal pickup and others. The company also provides international shipping and freight services. Next, on the logistics segment, the company also provides specialized logistics solutions such as security, mailroom, project handling, warehouse and distribution services, including land, air and ocean freight. So the last one, under property investment segment, the company provides prepaid products, facilities, asset management, including advising and insurance services. In addition, the company had a fleet of 1,331 of trucks and vans as of June 30 in year 2020. Okay, so now let's move to the strengths and weakness of the company. Gdex Berhad's strength, one of it is they have a strong management team. They also have a significant employees efficiency and greater parcel delivery. In addition, they also have a strong brand equity, and the last one is they have a scale economies when they consistently invest in wide capacity and underlying processes. Next is the weaknesses for Gdex company. The company is running business in a fragmented and competitive industry. They also have a high operating expenses, and the last one is they have a poor delivery service, with many customers complaining about late deliveries due to a lack of synergy between the shipping department and the customer support department.
Financial history. The financial history is based on income statement and balance sheets. This table shows the financial history of Pos Malaysia Berhad. As for the total asset, it has been increased till 2018 and start to decline on 2019. Meanwhile, for the total liabilities, it has been increased over year. The gross profit has been increased till 2018 and declined on 2019. Meanwhile, for the net profits, it shows that it is massively declined after 2018. Next, this table shows the financial history of Gdex Berhad. As for the total asset, it has increased year by year. Meanwhile, for the total liabilities, also showing the increase over year. The gross profit has been increased till 2018 and declined on 2019. Meanwhile, for the net profits, it has been up and down but still stable as it doesn't have massively dropped.
So let me continue to analysis of the current ratio of the Pos Malaysia Berhad and Gdex Berhad. Okay, so let me continue with the current ratio of Pos Malaysian Berhad. As we can see, this is the value of the current ratio of this company. So this is the graph, which is, as we can see, the declining of the trend of this company. So in 2016 until 2019, the current ratio of Pos Malaysian Berhad was in a good range, but in 2020 it was dropped until 0.94. It was in unpleasant range, which is the company having not enough current asset to repay the current liability. So this trend demonstrates the company is having difficulty to pay its current liability using its current asset. Therefore, this company show they unable to pay all the debt within one's time. Okay, so let me move to the current ratio of the Gdex Berhad. So as we can see, current ratio of the Gdex Berhad also show the declining of the trend. So but it is good in a good level, which is for 14.61 from 2016 until 2020, 4.74. It shows that the company has no difficulty in repairing its current or short-term liability using the current asset. However, a company with a high current ratio maybe have a outdated account receivable, or possibly it is because of the customer pay slowly, or which is hidden in the current ratio. Okay, so next we move to the quick ratio. So for the quick ratio of the post-Malaysian Berhad, this is the value of the quick ratio. So the quick ratio of post-Malaysian Berhad also shows the declining of the trend, which is 2016 until 2020, but within the range of 2019 until 2020, it was in unpleasant range, which is under than 1. So despite the facts that the overall analysis indicate that the company is having difficulty covering its current liability using its current assets, but it's not the analysis is not indicate that the company is having difficulty covering its current liability over the long term. Okay, so let me move to the quick ratio of the Gdex Berhad. This is the value and the graph, which is the quick ratio of the Gdex Berhad also shows the declining of the trend, which is the overall analysis of the quick ratio. So the company has enough quick assets to pay its current liability because of the value is more than 1. So furthermore, the creditors prefer to work with the business that have the higher quick ratio, and as a result, this company has a good chance to attract the investor to increase their capital. Okay, so let me continue with the comparison of the ratio. So let me start first with the liquidity ratio comparison between current ratio between post-Malaysian Berhad versus Gdex Berhad. So this is the value and the graph, which is, as we can see, current ratio of the Gdex Berhad is higher than post-Malaysian Berhad in almost the first 5 years, 2016 until 2020. So the conclusion that can be made is Gdex Berhad can handle its short-term obligation through the use of the current asset, but the post-Malaysian Berhad is considered that may be able to fulfill its short-term obligation. Okay, so let me move to the comparison quick ratio between the post-Malaysian Berhad versus Gdex Berhad. So this is the value of the ratio, and this is the graph between post-Malaysian Berhad and Gdex Berhad. So as we can see, Gdex Berhad having a higher value than post-Malaysian Berhad, and the conclusion that can be made is the Gdex company can pay its short-term obligation using its current assets, while the post-Malaysian Berhad is considered that a company that maybe can pay its short-term liability using the current asset.
An activity ratio is a type of financial metric that indicates how efficiently a company is leveraging the asset on its balance sheet to generate revenue and cash. There are 3 turnover in activity ratio: inventory turnover, fixed asset turnover, and total asset turnover. Inventory turnover is a ratio that measures the number of time inventory is sold or consumed in a given time period. The inventory turnover formula is calculated by dividing the cost of goods sold by average inventory. Based on the graph, in 2016, post-Malaysia Berhad had a high inventory turnover, but in 2017, the inventory turnover decreased to 129.50. In 2016, there were lower sales and lower demand for post-Malaysia Berhad goods. However, beginning in 2018, inventory turnover will grow through 2020. This demonstrates that a company is selling items fast and that there is a high demand for their products. Based on the graph, starting from the year 2016 until 2020, Gdex Berhad has a good inventory turnover. This demonstrates that Gdex Berhad sells items rapidly and that there is a high demand for their products. Fixed asset turnover is an efficiency ratio that measures a company's return on their investment in property, plant, and equipment by comparing net sales with fixed asset. The fixed asset turnover ratio formula is calculated by dividing net sale by the total property, plant and equipment net of accumulated depreciation. Based on the graph, starting from year 2016 until 2020, the fixed asset turnover is decreasing. It demonstrates that Pos Malaysia Berhad is not efficiently producing revenue through the use of its fixed asset. The largest fixed asset turnover for Pos Malaysia Berhad was in 2016 at 2.60 and the lowest was in 2020 at 1.48. Based on the graph, starting from the year 2016 until 2020, the fixed asset turnover for Gdex Berhad is decreasing. It demonstrates that Gdex Berhad is not efficiently producing revenue through the use of its fixed asset. The largest fixed asset turnover for Gdex Berhad was in 2016 at 4.72 and the lowest one in 2020 at 2.38. The total asset turnover is an efficiency ratio that measures a company's ability to generate sales from its asset by comparing net sale with average total asset. The total asset turnover ratio calculates net sale as a percentage of asset to show how many sales are generated from each ringgit of company asset. Based on the graph, starting from year 2016 until 2020, the total asset turnover for Pos Malaysia Berhad is decreasing. It shows that Pos Malaysia Berhad is not efficient at generating revenue from its asset. Meanwhile, in year 2019 and 2020, the total asset turnover will be maintained at 0.71. Based on the graph, the highest total asset turnover was in year 2016. However, in year 2017, the total asset turnover for Gdex Berhad decreased to 0.55, which is the lowest compared to the other years. Starting from the year 2018 until 2020, the total asset turnover is increasing, which is 0.59, 0.58 and 0.60. It shows that Gdex Berhad is efficient at generating revenue from its asset. Based on the graph above, Pos Malaysia Berhad ratio of inventory turnover had high inventory turnover in 2016 but decreased in 2017. However, the ratio of inventory turnover started to increase in 2018, 2019 and 2020. On the other hand, Gdex Berhad ratio of inventory turnover drastically increased from 2016 to 2020. As a result, Gdex Berhad has a greater inventory turnover ratio than Pos Malaysia Berhad since the firm sells items rapidly and there is a significant demand for their products. Based on the graph above, Pos Malaysia Berhad ratio of fixed asset turnover has decreased drastically in 2016 until 2020. The highest fixed asset turnover was in 2016 and the lowest was in 2020. On the other hand, Gdex Berhad ratio of inventory turnover also decreased in 2016 until 2020, but not drastically like Pos Malaysia Berhad. As a result, Gdex Berhad has a higher fixed asset turnover ratio than Pos Malaysia Berhad. However, both company is not efficient in producing revenue from its fixed asset. Based on the graph above, Pos Malaysia Berhad ratio of total asset turnover decreased in 2016, 2017, 2018, but remained constant in 2019 and 2020. The highest total asset turnover was in 2016 and the lowest one in 2019 and 2020. On the other hand, Gdex Berhad ratio of inventory turnover also decreased in 2016 until 2020. As a result, Pos Malaysia Berhad has a greater total asset turnover ratio than Gdex Berhad. However, both company is not efficiently utilizing its asset to produce revenue.
Okay, now I will explain on leverage financial ratio. A leverage ratio is one of the several financial measurements that look at how much capital comes in the form of debt, which is loans, or assess the ability of a company to meet its financial obligations. There are two main categories, which is financial leverage ratio and debt equity ratio. Next is the first main category, which is financial leverage. What is financial leverage? Financial leverage is the use of debt to buy more assets. Leverage is employed to increase the return on equity. However, an excessive amount of financial leverage can increase the risk of failure since it becomes more difficult to repay debt. Based on the graph, the group financial leverage for Pos Malaysia is in base year 2016, which is 1.68. However, starting from year 2017, it's increased until year 2020. The ratio is 2.77, which means the firm use more their issued debt that can negatively affect company's bottom line and earning per share. Therefore, it means that Malaysia is having higher company risk of the amount of debt in the company financial structure in 2020 compared to previous years. Next, we look at the trend analysis leverage financial ratio Gdex for 5 years trend. Gdex financial leverage ratio has increased from 1.12 to 1.36 over the past 5 years. A ratio 1.0 and above indicates that the company has more debt than assets. Referring to the graph, the good financial leverage for Gdex is recorded consistent in year 2016 and 2017, which is 1.12. However, in 2020, the ratio shows the higher financial leverage than the previous years, which is 1.36. This indicates that Gdex are having higher company risk of the amount of debt in the company financial structure on the latest year. Next is debt equity ratio. What is debt equity ratio? Debt equity ratio is calculated by dividing a company's total liability by its shareholder equity. Debt equity ratio is an important metric used in corporate finance. It's a measure of the degree to which a company is financing its operation through debt versus wholly owned funds. Next, debt equity ratio for Malaysia for 5 years trends. By looking at the graph, the value of Malaysia's debt equity is not recorded in 2016. But starting from year 2017, the ratio is increased from 0.01 until year 2020, which is 0.41. Hence, this has shown that Malaysia is having higher company risk in 2020 of the amount of debt in the company financial structure based on 5 years trends. Okay, next we look at the trend analysis debt equity ratio for Gdex. Based on the graph, Gdex debt equity ratio is inconsistent over the past 5 years. We can see that the highest ratio is in year 2020, which is 0.15. This indicates that in year 2020, the company is borrowing more money to fund its operations, putting the corporation at a larger risk of debt accumulation than in past years. Okay, now let's move to comparative analysis for financial leverage between Malaysia and Gdex Berhad. While looking at the last 5 years trend, Malaysia's latest ratio of financial leverage peaked in 2020, which is 2.77, while Gdex is 1.36. Malaysia's ratio of financial leverage hit its 5 years low in 2016 of 1.68. Meanwhile, Gdex hit lower ratio in 2016 and 2017, which is 1.12. Okay, so from here we can see that Gdex is having lower financial leverage ratio than Malaysia. So the firm is good in managing its debt and may face low company risk of the amount of debt in the company financial structure compared to Malaysia. This can be proved that Gdex is the best choice because the company has lower financial leverage. Okay, so for comparative analysis of debt equity ratio between these two companies, which is Malaysia and Gdex Berhad, we can conclude that from the graph, Malaysia is having higher debt equity ratio than Gdex in 2020. Okay, as is in this case, a debt ratio of 0.5 or less is considered to be less risky in any industry. Overall, the two companies, which is Malaysia and Gdex, is good in managing their debt and may have low risk with their financial. However, Malaysia has highest level of debt compared to Gdex company. This can be proved that Gdex is the best choice because the company has lower debt.
Next, I will continue with the profitability ratio. Profitability ratio is to measure a company's effectiveness to generate profits from investment and sales. Firstly, the graph shows the trend analysis return on assets ratio of Malaysia Berhad from 2016 to 2020. From the graph, we can see that the ratio keep decreasing each year, especially in 2019 where the ratio suddenly declined to negative 4.98 from 2.81 in 2018. Therefore, the trend analysis shows that Post Malaysia Berhad not using its total assets effectively to generate net profit. Based on the graph, we can see that return on assets ratio decreased from 2016 until 2018. In year 2019, there is a slight increase to the return on assets from 4.74 in 2018 to 6.05. However, it declined again in year 2020 to 3.06. So, based on the trend analysis, Gdex Berhad is doing a good job of increasing its profit with each investment dollar it spends in year 2019. The graph shows the trend analysis return on equity ratio of Post Malaysia Berhad for the 5-year trend. From 2016 to 2018, the ratio reduced by a small amount, which is 5.64 in 2016, 5.51 in 2017, and 4.80 in 2018. But it suddenly dropped to negative 9.06 in 2019. Declining return on equity suggests that Post Malaysia Berhad is becoming less efficient at creating profits and increasing shareholder value. The ratio in year 2016 is 13.04. It dropped again to 9.06 in 2017 and continued to decrease in 2018 with 5.40. The decrease indicates that the company is not using their total equity to generate net profits efficiently. In year 2019, the return on equity ratio increased to 6.99, and the analysis indicates that Gdex Berhad is increasing its profit generation without needing as much capital. Unfortunately, return on equity in year 2020 is decreased again to 3.85. I will continue with the comparative analysis for return on assets. By looking at the last 5 years trend, the highest return on assets for Post Malaysia Berhad and Gdex Berhad is in year 2016 with 3.56 and 11.04 respectively. In addition, both Post Malaysia Berhad and Gdex Berhad faced the lowest return on assets in year 2020 with negative 9.46 for Post Malaysia Berhad and 3.06 for Gdex Berhad. This situation indicates that a low or negative return on assets suggests that the companies cannot use their assets effectively to generate income. Thus, it is not a favorable investment opportunity in that year. As a result, Gdex Berhad has higher return on assets than Post Malaysia Berhad. So, Gdex Berhad is more better and effective in using its total assets to generate net profits. Next, move on to the comparative analysis of return on equity. By looking at the last 5 years trend, the highest return on equity for Post Malaysia Berhad is in year 2016 with 5.64, and Gdex Berhad also have the highest return on equity in year 2016, which is 13.04. As shown in the graph, both companies having the lowest return on equity in 2020 with negative 23.74 for Post Malaysia Berhad and 3.85 for Gdex Berhad. As a result, Gdex Berhad has higher return on equity than Post Malaysia Berhad. Thus, it shows that Gdex Berhad is more effective and better in generating net profit using its total equity.
Based on the case study, there are a few recommendations for Post Malaysia Berhad and Gdex Berhad to improve their financial position calculation of the financial ratio above. For liquidity ratio, we can conclude that Gdex Berhad has higher liquidity compared to Post Malaysia Berhad. Our recommendation for Post Malaysia Berhad to improve their liquidity ratio is by increasing the value of their current asset and also decreasing current liabilities by paying off debts or negotiating terms of payment with creditors. Next, The activity ratio indicates that the efficiency of both Malaysia Berhad and Gdex Berhad is poor, and both companies are unable to manage and fully utilize their asset very well to generate sale. The recommendation to improve for both companies is to improve total asset turnover by increasing sale as well as selling the asset that they are not using anymore. Moving on to leverage ratio, Gdex Berhad is good at managing its debts and may face low financial risk. Our recommendation to Post Malaysia Berhad is that there must be some improvements that should be made, such as can be achieved by increasing the price, increasing sales, or reducing the cost. Other than that, to pay off existing debt, the additional funds earned can then be used. Lastly, based on the profitability ratio, Post Malaysia Berhad and Gdex Berhad are inconsistent in terms of earning profit per ringgit, and it is difficult to convince shareholders to invest in the company. The recommendation is to reduce the company's inventory by controlling the movement of the stocks. In addition, remove uncompetitive goods and services.
For conclusion, by looking on 5 years trend analysis, both companies show the decline in financial performance from 2016 to 2020. Liquidity for both companies decline shows the companies have an excessive amount of liquid assets on hand as well as excessive amount of liquidity, which translates to a low risk of insolvency and poor predicted returns. Leverage for both companies increased as higher earning before tax operation. Profitability for both companies show decline as the increase of the cost of goods sold and overall cost of the operation. Finally, activity for both companies show the decline except for inventory turnover indicates relatively low profits compared to its full potentials. Next, based on comparative analysis, the expectation of Gdex Berhad performance look profitable as it has great firm's financial performance compared to Post Malaysia Berhad. According to liquidity ratio, it has more ability of firm to pay its short-term obligation using current asset. Based on the activity ratio, it has high efficiency of the firm in using asset to generate cash and sale. Leverage ratio shows that it has high ability to fulfill pay of the financial obligation as it has low company's level of debt. Regarding to profitability ratio, it has more effectiveness to generate profits from investment and sale. Overall, Gdex Berhad appears to be a suitable company to invest in, as the firm has shown consistent profit growth while cutting dividends to restructure its capital in order to pay off its debt and pump cash into its capital at a low cost. Investor sentiment is to pay for Gdex Berhad stocks, resulting in a fragmented price.